Hi, I'm Peter Rose, founder of Longwood Currency Trading. I came into some interesting results from analyzing my 2023 trading metrics, and I'd like to share that with you because it's very revealing as to how metrics can alert you to certain things that you may be doing that could be improved. Well, first up is looking at the two different types of trading that you can do, and that I do as well. One is an all-in, all-out situation. You're trading with three full lots. You go in 3 full, and you come out 3 full. The other way you can go in is by staging, or first by building and then staging. I've gone over all that. We'll just in other videos, so we'll just call that staging. So you've got 3 lots. You go in with one. You stage another one, and you stage another one, and then when you come out, you pull them all off, or I'm not a fan of, you pull them off incrementally. I think that reduces your overall, well, your percentage gain against your risk, because you're pulling off, when you pull off under FIFO rules, you're pulling off the early one, which is really the one that has the most profit to it. So I'm just, anyway. You can either be an all-in, all-out trader, or you can stage. In developing trading metrics, my counsel to those who listen to me is, as you're learning, just be all-in, all-out. What that enables you to do, and even if you're not just learning, maybe I've talked with some folks that are good traders. They're just trying to get better, and they're trying to do all this complicated stuff. They say, look, let's back up and start over again. And one of the things that we work with together is being an all-in, all-out trader, because what that does is if you do enough of them, it gives you a clear understanding of what your trading metrics are. Because once you start trading multiple lot positions, staging in and out, the trading metrics become invalid for certain uses, and you have to change them to measure different aspects of the trading. But if you don't have a good, solid concept of what your trading is doing as all in, all out, then it's going to be very difficult for you to make decisions based on when to stage, how many to stage, the distance between the staging points, what your risk profile looks like on a runner, all kinds of questions that you need to resolve once you start doing more complicated trading process. Oh, and the fact that when you're doing positions, if you're staging, at one time you may work with a 5 or 8 lots, and so you do a few trades, and then all of a sudden you jump to 12 lots. Your position is a 12-lotter, and then you drop and you do a 3 lot, and you get pumped out early, and so you lose. You go in with another 3, and you add 2 to it. Now you get a 5. Now you go in again, and you do a 3, and you're all in, all out. So once you start changing too many parameters of what your trading is doing, then doing the metrics to calculate how you're doing has to change in regard to that. For example, the win-to-loss ratio, which is not really a ratio, I do it as an equation because it has so much value. The win-to-loss ratio is a transaction-based metric. Once you start doing multi-lot positions where you're staging, now the win-to-loss ratio can still be valid, but most likely it's not. And this is one of the interesting things that I knew intuitively just because I've been trading, but it's a reflection of the metrics change that I do. when I ran my metrics, and I'm trading a six-figure account, and so I'm building positions and staging into them, and sometimes I will, I'll be all in, all out, because I'll start with a 5 lot as an entry size, and it'll go, and then it'll start to flutter a little bit, and I'll be out. But most of the time, I'll go in 3, 5, 8 lots as a starter point and then build from there. So I'm all over the place in what I'm doing. When I had that really, really miserable loss that I had this year, I started over and rebooting. I dropped my lot size, and I became all in, all out. And I measured that specific time period after taking that big loss, and when I went back to my just all in, all out trading. And it didn't last very long. It was a couple of weeks. I made a lot of trades, but it was a few weeks period of time. But I had at least a reasonable data sample of trades to develop a win-to-loss ratio all in, all out. And I could compare that to the previous years where I've done stretches of all in, all out. I know what my all in, all out win-to-loss ratio is. I'm about a 70-30 trader on all in, all out. However, when I take the full year of 2023, even with massive losses and big gains and all that sort of stuff, those transaction-based metrics were 60-40, which I had determined 2 years ago would probably be the result, is that I wouldn't have this as strong of a transaction metric that on a win-to-loss ratio as I had, because when you're staging, you go in light, you probe, you come out right away if it goes against you. You go back in, you come out right away when it goes against you, or you get tagged out, whatever it is, it happens. So you've got this dance going on constantly as to more and more losses, but larger gains, okay? And the reason that you get the larger gains is because you've reestablished how you determine your profit targets, so you've got more real estate to run to build these positions. And when I work in a mentoring situation with somebody, that teaching process of that building stage is very, very critical, and it's different than what you're trying to accomplish once you get into staging the lots in. And so that's mixing another methodology. So not only have you moved from all in, all out, but you're moving to a methodology of staging, and that staging methodology can be a build and then staging, or you can go right to staging. And a lot of people wouldn't differentiate the difference between building a position and staging into one. I think that's a misnomer, and I think that you're not really understanding the risk management the way that I do. In any event, the interesting thing that came out from my win-to-loss ratio, transactional-based metrics, was that I'm 60-40 on a transactional basis when I'm trading in a staging environment, is what I'm trying to say. And that proves that I'm taking a lot of small losses and then holding on and getting the gains. Interestingly also is that I had something like, I think it was 400 positions or something that I took during the year. In other words, a position could be comprised of a series of transactions. I had 934 transactions in 2023, and of those I came out with about 400 positions, closed positions. So it was interesting to see that on a closed position basis, as opposed to the transactional basis, is that on the transactional basis you can calculate your winning trades as opposed to the number of losing trades that you did, and the longest stretch of losing trades that I had was 6. I had at least one period of 6 losing trades in a row. Interesting. So the metrics provide sort of a back view of how you did. But more importantly than that is that the metrics then enable you to make changes to how you're trading. We could say that, well, I calculate on a transaction basis the number of wins versus the number of losses. What is that ratio is overall? And the number of times that I've lost in a row and the number of times that I won in a row. How does it all work out from a probabilistic standpoint? I wrote a computer program last year that takes all kinds of permutations of staging into a position based on different win-to-loss ratios and other metrics that I change. It's a pretty complex matrix of parameters that change, and you run 1,000 repetitions of this matrix. There's probably 6 different variant paths through a matrix system that you can run on this stuff. So you run 1,000, you've actually done about 20,000 computations. So it takes a while, even on a computer with a pretty good spin cycle to it. But those simulations have proven themselves out in real time with me. What is my expected win rate? How do my simulations match up with what I'm actually doing? From a total value, it's a little difficult because because I dropped 6 figures, and that just went bad. So that kind of screwed up the dollar value of what I won. I mean, my average win is X, and my average loss then becomes 4 times the average win. If I run my metrics program statistics against that transaction report from the broker, and I eliminate the trades that it was one trade, one position, where I lost 6 figures. If I take that out, now all the metrics align with themselves, and it just points really badly to that, and it says, don't do that again. Whatever it is that you did, don't do that. So I know exactly what I did on that one. I have other large losses that I've had throughout the course of the year, but I've also had large gains, and several of them in a row to make them up. For example, after I took that large 6-figure loss in 3.5 months, I made $90,000 of that back, and then took another big loss that took most of that $90,000 away, because I was experimenting with where am I going wrong. If you don't make the mistake enough times, then you can't, and you're looking at these metrics, you can't really just take a big loss like that and go, oh, I understand totally what happened. Because what happens? You're going to do that again. You're going to make that same mistake again, because just doing it once or twice really isn't enough. The trick in the thing is, you take an enormous loss like that, you have to back up and say, okay, let me rebuild my foundation of understanding of what my methodology is, so that when I replicate that error, I do it with less dollar loss. I didn't do that because it was such a big loss, and I took that in mid-July, so I only had half the year to try, to make that back, and I made. I mean, it was more than 6 figures. It's more than 100 grand. So I was able to make that back and bring it down to. I made a large chunk of that back, but still left with a 6-figure loss for the year. But a small 6-figure loss as opposed to a big 6-figure loss. And the only way I was able to do that was I've been trading long enough that I suspected that I knew what that was. I'm pushing the envelope because I was running out of time. I wanted to try to see if I could make that money back by the end of the year in 6 months. And so I did. I came back $90,000, and I'm looking at my metrics and I'm saying, geez, I'm doing all the right things, so everything is okay. And then I get stuck in a few trades. I tend to think that from a transaction standpoint, that's where I ran into those 6 losses. I'd have to go back and look at the actual register to see. But when you are trading for the dollars, which I try not to do, you become agnostic to your metrics and you do stupid shit. That's all. You invert fear and greed, and you throw in a sprinkling of hope, and you're screwed. And if you look at the transaction register, when I take my broker's transaction register, it translates into lines of closed positions. It isn't on the transaction basis, it's on the position, closed position. So there's one line across there, because when I report that for taxes, I have another program I wrote that pulls all that data together and produces my transaction tax report, so that I don't have to pay an accountant $600 to do that, which I did the first time I did that 4 or 5 years ago. It cost me $600 to process 300 positions. And I just thought, that's just stupid, because they had to do it all by hand. But I suspect that, and I haven't really gone back and looked at the transaction report to find out where those particular runs of 6 losses came in. But I suspect that played a part in where I was pushing the envelope. I'd made 90. Okay, I got to make it. I did that in 3.5 months. I got about 3.5 months. Let's run it through and see if I can do that and kind of cut down on the size of that loss that I took. And I got it wrong. So I lost that, and then I don't know. I think that was October, right? July, August, September. Yeah, so that was October. So October, I think I did 35,000 net. It was about, I think that was 18% against my risk, and then I did a $19,000 month. $19,000 month in December. I was shooting to try to get 20, and I was at 23, and then I took a hit of $4,000 or something on the last trade I put in. I go, okay, I'm not going to try to push this anymore, and I just shut it down. But I did make my last trade on the 28th or the 31st or whatever the last day is. I could close the position. I'm not trading anymore. I'll take the $19,233 for the month and that was, I don't know, something like 13% on my against my risk. So if I look over the course of the year and I'm trying to look at my return against risk, what did I make on my bank? The numbers don't make any sense because of that large loss. Now, if I did the large gain, which I could do again, and I just took a little bit too much of a loss against it because I was pushing to the end of the year trading for dollars. That was my mistake. If I would have just proceeded on and I would have had more time, if the bear wouldn't have stopped the shit in the woods, the hunter would have never seen him to shoot him, I could probably come out with a valid, this is my capability. It doesn't matter how much money you make so that you're saying, well, I made, for the year I made 8% against my on my money, or I made 48% against it, or whatever. I can look back and say I made 12%, and the next year I was at 31%, and I can go on through like that. But when you take a huge loss like that, obviously your return against bank is severely negative. So you have to take that large loss out and say, okay, under normal rational trading, when your brain isn't diseased and you're doing stupid shit, what are you capable of doing? What's your ability level? That's why these metrics are so important. And I've yet to really talk with anybody who uses those metrics. Chess players go back over the chess games that they've played in the past, and they go over their opponent's chess games. Those are the metrics of the game. I don't understand how anybody trades without taking this approach. Well, look, I've got a degree in physics, almost a minor in math. I did real estate investment for 40 years, and came out of all that after losing $1 million twice in my life. It took me 10 years each time to make that $1 million back, and still come out at the end with over $1 million of net worth that I could retire on. It's an interesting process to be able to look back and say, oh, okay, I have a process, and that process is based on metrics. And if I follow the metrics, which can be theoretically determined up front based on your personality and other criteria that I work with people on in trading as to how to form their trading plan, then I just don't see where the folks that are getting into trading don't take a pause back and say, this isn't ping pong here that we're doing. This is financial trading, and it needs to be taken seriously. It needs to have a plan. How do you build a plan if you don't know where you're trying to get to? You have to dry lab this stuff, and it's very difficult to do on your own. You need a mentor, just like if you're join a swimming club. You need the coach to tell you, well, today you need to swim 8 full laps, and tomorrow you're going to swim 12, and then you're going to go back and swim 2, but you're going to go bust out. That's all part of that coaching process, right? And so the thrust of this video is the interesting conclusions after the dust settles in some period of time, which is a year. That's a great time for you to reflect back on those metrics, to gain insight into how well the trading plan that you have works as long as you follow that trading plan, and how you could go in and manipulate the transaction register such that I understand what I did here, I fixed that, I'm not going to do that again. So if I remove that from my analysis, how does that change what I am actually capable of doing? Sometimes it's more important to know what you're capable of doing than what you did, as long as you learn from your mistakes. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.